Welcome to Market Brief After Hours. It is the start of a brand new trading month, and Wall Street decided to kick off June with a historic bang. We saw record-shattering highs across the major U.S. indices today, driven by an absolute powerhouse performance in the tech sector. But while U.S. equities were celebrating, we saw a very different story unfolding in Europe, a massive spike in oil prices and some serious technical shifts in the foreign exchange markets. There is a lot to unpack from today's action. Let's start with those record-breaking numbers on Wall Street. How did the major indices wrap up the day?
It was a spectacular session for U.S. equities. All three major benchmarks reached new all-time intraday highs and closed at record levels. The S&P 500 advanced 0.26% to finish at 7,600. The Nasdaq Composite led the charge, gaining 0.42% to close at 27,087. Meanwhile, the Dow Jones Industrial Average added about 46 points, or 0.09%, to end the day at 51,079.
Unbelievable strength to start the month. And it seems like a familiar name was holding up the broader market once again. Tech was the star of the show, wasn't it?
Absolutely. Nvidia was the primary catalyst here. Its shares surged more than 6% after the company unveiled a brand new processor designed for personal computers. That announcement sent a massive wave of optimism through the entire hardware sector. We saw Dell Technologies skyrocket more than 10%. However, it wasn't a rising tide for all boats in the chip space. Intel, which has historically dominated the PC market, fell more than 4%, and Qualcomm tumbled 8% as investors shifted capital toward the names leading this new AI-driven PC cycle.
Right, so a bit of a shakeup in the chip hierarchy. Now, outside of technology, there was only one other sector in the green today on the S&P 500, and that was energy. What was happening there?
Energy stocks had a very strong day, closely tracking a sharp rally in crude oil. Within the sector, Marathon Petroleum was a standout performer, climbing about 4%. The oil giants also posted solid gains, with ExxonMobil up 2.8% and Chevron increasing by 1.9%. This came as oil prices surged. West Texas Intermediate crude futures jumped 5.93% to settle at $92.54 a barrel, while Brent crude advanced 4.24% to settle at $94.98.
That is a significant move in oil, especially considering how rough May was for the energy complex. What triggered this sudden spike?
It was largely driven by geopolitics. Over the weekend, we saw a rapid escalation in Middle East tensions, with reports of halted communications and concerns over key shipping routes like the Strait of Hormuz. Whenever there's a threat of supply disruptions in that region, the oil market reacts quickly. However, some analysts, like Tim Holland over at Orion, are suggesting this might be a temporary bump. He noted that the market isn't necessarily pricing in a full-scale, long-term escalation of hostilities, and we might still be closer to an off-ramp for this conflict. But for today, the fear premium was definitely back in the price of crude.
It's a very fluid situation, and we'll certainly keep an eye on how those geopolitical headlines develop. On the domestic front, we also got some fresh economic data today. U.S. manufacturing seems to be holding up better than many anticipated.
That's correct. The Institute for Supply Management released its manufacturing gauge for May, and it beat expectations. The ISM Manufacturing Index came in at 54, which is up 1.3 points from April, and higher than the consensus estimate of 53.2. Remember, any reading above 50 indicates expansion. We saw new orders rise by 2.7 points to 56.8, and imports grew at a similar clip. Employment also improved, though at 48.6, it's still technically contracting. Interestingly, the prices paid index eased slightly by 2.5 points, but at 82.1, inflationary pressures in manufacturing remain quite high.
And how did the bond market digest all of this? I imagine yields were on the move.
Indeed they were. The 10-year Treasury yield, which is a critical benchmark for consumer debt like mortgages and auto loans, ticks higher to finish at 4.459%, after climbing as high as 4.518% during the session. The 2-year Treasury yield, which is highly sensitive to the Federal Reserve's interest rate outlook, rose more than 2 basis points to 4.037%. On the long end, the 30-year bond yield actually fell slightly, down about 1 basis point to 4.978%.
Fascinating dynamics. We are going to take a very quick break to hear from our sponsor, but when we return, we will cross the Atlantic to see why European markets didn't share Wall Street's optimism, dive into some critical technical setups in the Forex market, and look at some massive corporate acquisitions. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were looking at a record-breaking session on Wall Street. But as we turn our attention across the Atlantic, the mood in Europe was decidedly more somber today. Why did European equities struggle?
European investors had to grapple with the direct economic fallout of those Middle East tensions, particularly around supply chain disruptions and rising costs. The pan-European Stoxx 600 index ended the session about 1% lower. Looking at individual countries, the UK's FTSE 100 fell 85 points, or 0.82%, to close at 10,324. In France, the CAC 40 dropped 0.4% to finish at 8,147. Italy's FTSE MIB fell 0.52%, or 262 points, to close at 49,775, and Germany's DAX fell 102 points, or 0.40%, to end at 25,003.
So a pretty broad sell-off. Were there any bright spots at all in Europe today?
There were a couple of notable exceptions. First, Europe's tech index bucked the trend, closing 1.4% higher to reach its highest level since September 2020. This was fueled by Japan's SoftBank group pledging to invest 45 billion euros, about $53 billion, in France over the next 5 years to build out artificial intelligence infrastructure. The other big story was in the airline sector. EasyJet shares skyrocketed 10% after reports emerged that the U.S. investment firm Castlelake is considering a potential takeover bid for the British budget carrier.
That's a massive boost for EasyJet. But let's talk about the macroeconomic data coming out of Europe, because it seems like inflation and supply chain pressures are really starting to bite.
They certainly are. In the UK, manufacturers raised their prices at the fastest rate since June 2022, driven by soaring input costs from those shipping disruptions. The UK manufacturing PMI actually rose to a revised 53.9. We saw a similar story in Italy, where input cost inflation accelerated to 76.5, the highest reading in 4 years, pushing headline consumer inflation up to 3.3%. Meanwhile, France's manufacturing PMI slipped back into contraction territory at 49.7. To top it off, euro area unemployment ticked up to 6.3% in April, which was slightly worse than market expectations.
It sounds like a very challenging stagflationary mix for European policymakers. And we are seeing these macro divergences play out in the foreign exchange markets. Let's look at some of the major currency pairs, starting with the euro.
The euro had a tough day. Euro USD declined 0.26% to close at 1.1630. From a technical perspective, this bearish move pushed the pair below its 50-day simple moving average, which sits at 1.1666. It's also trading well below its 100-day SMA at 1.1698 and its 200-day SMA at 1.1681. This suggests that the bears are temporarily in control, and we could see a test of the lower range support near 1.1540. Against the British pound, the euro also faced rejection. Euro GBP closed down 0.22% at 0.8642, continuing its medium-term downtrend below its 50-day, 100-day, and 200-day moving averages.
What about the pound against the US dollar? Did it hold up any better?
The sterling managed to stabilize, closing virtually flat at 1.3456. It's currently in a bit of a transition phase, wedged right between its 50-day SMA at 1.3448 and its 100-day SMA at 1.3477. Crucially, though, buyers stepped in to defend the intraday dip, keeping the pair above its key 200-day SMA at 1.3423.
And how did the Swiss franc and the Japanese yen perform against the greenback?
The US dollar made significant gains against both. USD CHF advanced 0.82% to close at 0.7867, successfully reclaiming its 100-day SMA at 0.7830 and its 50-day SMA at 0.7865. The next major hurdle for USD CHF is the 200-day SMA at 0.7906. As for USD JPY, the uptrend remains incredibly strong. The pair rose 0.3% to close at 159.71, trading comfortably above its 50-day SMA of 158.80 and its 200-day SMA of 155.10. It looks like buyers are setting their sights on that psychological 160.00 level.
With the dollar strengthening, I assume gold took a hit today.
Yes, gold resumed its downward trajectory, dropping 1.3% to close at $4,479.
The precious metal has been in a steady downtrend since peaking above $5,000, and it's now trading below both its 50-day SMA of $4,626 and its 100-day SMA of $4,795. Technicians are now watching the 200-day SMA at $4,380 as the next major support level.
Now, let's pivot to the cryptocurrency space because we saw some highly unusual activity from one of Bitcoin's biggest corporate backers today.
This was a major talking point. Strategy filed a disclosure showing they sold $2.5 million in Bitcoin last week. Now, to put this in context, this is only the second time the company has ever sold Bitcoin, representing a significant shift away from their long-standing never-sell philosophy. They are moving toward actively managing their balance sheet to improve per-share metrics. This news, combined with 10 consecutive days of net outflows from Bitcoin ETFs, put heavy pressure on the crypto market. Bitcoin fell 2.87% to around $71,500, its lowest level since mid-April. Consequently, Strategy shares fell 5.8%, Robinhood dropped 3.79%, and Coinbase declined nearly 3.4%.
A major strategy shift indeed. Let's wrap up with some of the individual corporate market movers of the day, because we had some absolutely massive earnings and M&A announcements.
It was an incredibly busy day for corporate news. First up, Hewlett Packard Enterprise. Their shares skyrocketed a staggering 30% today. They posted blockbuster second-quarter results that completely blew past Wall Street estimates, with revenue up 40% compared to a year ago, largely driven by massive demand for AI-related servers.
30% in a single day is an incredible move for a company of that scale. What else caught your eye?
We saw some massive consolidation in the housing and hospitality sectors. Taylor Morrison home shares surged 22% after Warren Buffett's Berkshire Hathaway agreed to acquire the home builder for $6.8 billion. Berkshire CEO Greg Abel praised the company as a best-in-class builder that will help deliver homeownership to more Americans. And finally, MGM Resorts International saw its shares surge 16% after Barry Diller's People Inc. made an offer to acquire the company for $48.30 per share in cash. Diller, who actually sits on MGM's board, has recused himself from the board's discussions regarding the proposal.
That wraps up today's analysis. If you find this useful, please follow Market Brief After Hours. We will be back tomorrow with more deep dives into the global markets. Have a great evening.